Hey there, ready for a deep dive into the mind of Warren Buffett?
And we're going to extract the core principles, that kind of transformed him into a financial titan.
Using the Warren Buffett Way by Robert G. Hagstrom as our guide.
Yeah, this goes way beyond like the usual investment advice.
Right.
We're uncovering those like philosophies and the mentors that truly shaped Buffett's thinking.
Yeah.
You might be surprised by what we uncover.
Okay, so like everyone knows about Buffett, right? But what makes this deep dive different? What's like the hidden layer we're going to uncover?
It's the profound influence of four key figures.
Okay.
Think of them as the architects of Buffett's investment style.
Okay, I'm all ears.
All right.
Who are these figures and how did they like shape his approach?
We've got Benjamin Graham, we've got Philip Fisher, we've got John Burr Williams,
Okay.
and of course, Charlie Munger.
Mm-hmm.
Each one brought something unique to the table,
Okay.
and together they form like the foundation of Buffett's strategy.
So let's start with Benjamin Graham. I know he's considered the dean of financial analysis, but what exactly did he teach Buffett?
So picture like the investment landscape after the 1929 crash.
Yeah.
Chaos, uncertainty.
Right.
That's where Graham's influence shines.
Mm-hmm.
He literally wrote the book on it, security analysis.
Right.
His core principle was the margin of safety,
Okay.
and it's incredibly relevant even today.
The margin of safety? Okay. Refresh my memory on that one.
Sure. It means buying securities for less than their true intrinsic value.
Okay.
It's like having a built-in cushion
Mm-hmm.
protecting you, even if the market, takes a downturn.
Right.
Think of it like this. During the dot-com bubble, everyone was chasing internet stocks, right?
Yeah.
But Buffett stayed away because he didn't see that margin of safety.
Mm-hmm.
He wasn't willing to gamble on overpriced companies, no matter how trendy they seemed.
So Graham was all about minimizing risk, even if it meant missing out on some of the hype.
Exactly. He was a master at separating emotions from investing decisions, which is something Buffett learned and applied throughout his career.
Right.
This principle allowed him to remain grounded during market swings, focusing on logic and intrinsic worth.
Okay, so Graham provided the foundation of logic and risk management. Who's up next in shaping Buffett's investment style?
Philip Fisher.
Okay.
And he brought a completely different perspective.
Right.
While Graham focused on numbers, Fisher emphasized deep dives into the companies themselves, going beyond the balance sheet.
So what did Fisher consider when evaluating a company? What factors did he prioritize?
Everything from growth potential and management quality to the company's culture and competitive landscape.
Okay.
He even pioneered a method called scuttlebutt to gather intel.
Scuttlebutt. Is that some kind of secret code?
It's about gathering information from unconventional sources.
Okay.
Imagine talking to competitors, former employees, even customers.
Okay.
Anyone who could give you the real scoop on a business.
Mm-hmm.
It's like being a detective, uncovering insights that don't appear in financial reports.
Interesting.
Think about Buffett's investment in Geico.
Okay.
He didn't just rely on their financials. He spent hours talking to Geico employees, understanding their culture and their operations.
Mm-hmm.
This deep dive gave him confidence in the company's long-term potential.
So Fisher emphasized a more holistic view, understanding the human element behind the numbers.
Yes,
I could see how that would be valuable.
absolutely.
Okay.
And Fisher also believed in focusing on a few exceptional companies,
Okay.
rather than spreading investments too thin.
Right.
He advocated for quality over quantity, which aligns with Buffett's concentrated portfolio approach.
This is fascinating. We've got Graham's focus on the numbers, Fisher's deep dives into the businesses themselves. It's like two different lenses coming together to form a sharper picture.
Precisely. And it gets even more interesting when we add the third influencer, John Burr Williams, to the mix.
Okay.
He provided the mathematical framework to support these approaches.
Ah, the numbers guy.
Yeah.
How did Williams contribute to Buffett's investment strategy?
Williams was an economist who believed a company's worth is tied to its future cash flow.
Okay.
He even wrote The Theory of Investment Value, outlining a concept called the discounted cash flow model.
So this is about looking into the future, not just at the present.
Exactly.
Predicting a company's earning power.
The discounted cash flow model provides a concrete way to calculate a company's intrinsic value by predicting future cash flows and then discounting them back to their present value.
Right.
This concept became a cornerstone of Buffett's investment approach, enabling him to assess the true worth of businesses beyond their current financials. For example, when analyzing Coca-Cola, Buffett didn't just look at their current earnings.
Right.
He projected their future cash flow, taking into account their brand strength, their global reach, and the potential for continued growth.
So it's about understanding the long-term potential, not just chasing short-term gains. This
Yeah.
is really insightful.
Yeah, it is. And this model helps explain why Buffett often invests in companies that might not seem attractive at first glance.
Okay.
He's not just buying cheap stocks, he's buying companies with the potential to generate significant cash flow in the future.
All right, so we've got Graham's margin of safety,
Yes.
Fisher's deep dives,
Uh-huh.
and Williams's cash flow model.
Right.
That's quite a powerful combination.
Yes.
Who's the final piece of this puzzle?
The final and perhaps most influential piece is Charlie Munger,
Okay.
Buffett's longtime partner.
Mm-hmm.
He brought a unique blend of wisdom, challenging Buffett's thinking and pushing him to evolve.
Okay, tell me more about Munger. What was his special sauce?
Munger is more than just a business partner.
Okay.
He's a big picture thinker, fascinated by psychology, history, and various disciplines.
Mm-hmm.
He broadened Buffett's perspective, encouraging him to see beyond just bargain hunting.
So he's like the philosopher of the group, the one who connects the dots between different fields.
That's a great way to put it. Munger recognized that sometimes paying a fair price for an exceptional business is better than stubbornly searching for a bargain.
Okay.
He understood that quality often comes at a price, but that price can be worth it in the long run.
Right.
Think about See's Candies.
Okay.
Buffett initially thought it was overpriced, but Munger convinced him otherwise.
Interesting.
He saw the brand loyalty, the pricing power, and the potential for growth.
Mm-hmm.
This investment, influenced by Munger's perspective, turned out to be one of Berkshire's most successful.
But Munger helped Buffett refine his approach, moving beyond just finding cheap stocks to recognizing the true value of exceptional businesses.
That's exactly it. Munger's influence was crucial in shaping Buffett's evolution, from a strict value investor to a more nuanced thinker who appreciates both value and quality.
This is incredibly insightful. We've got these four figures, each with their unique contribution to Buffett's investment philosophy. It's amazing how seemingly different approaches can come together to create such a successful strategy.
It's like a perfectly balanced recipe. And now the real question is, how did Buffett integrate these diverse influences into his own unique style?
Right.
Did he just rigidly follow their advice, or did things evolve over time?
That's a great question. How did Buffett's investment strategy actually play out in practice?
Right.
Did he stick to the script or did he deviate and adapt?
That's where it gets really interesting.
Okay.
You see, Buffett didn't just blindly follow his mentors. He took their ideas and evolved his strategy over time.
Okay.
He was constantly learning, adapting, and refining his approach based on his experiences.
Interesting.
In the next part of our deep dive, we'll uncover how Buffett blended these influences, examining his evolution as an investor.
Okay. I'm already intrigued. Can't wait to see how this all played out in the real world. All right, listeners, make sure to tune in for part 2, where we'll unravel the evolution of Warren Buffett, the investor. It's going to be a fascinating journey.
We'll see you then.
Welcome back. Last time, we kind of laid the groundwork exploring the 4 major influences on Warren Buffett's investment style.
Right. We saw how Graham's focus on the numbers, Fisher's deep dives, Williams's cash flow model, and Munger's big picture thinking all contributed to his success.
Right. It's like they each provided a piece of the puzzle, shaping Buffett's approach to investing.
And now we're going to see how those pieces came together.
Okay.
And how Buffett's strategy evolved over time.
Okay, let's dive into some real-world examples.
Right.
How did Buffett actually put these principles into action?
One of his early triumphs, American Express,
Okay.
is a perfect illustration.
American Express, the credit card giant. What's the story there?
It takes us back to the early 1960s.
Okay.
Remember, this is when Buffett was still heavily influenced by Graham's bargain hunting approach.
So he was looking for companies trading below their intrinsic value, those hidden gems the market had overlooked.
Exactly. And American Express, found itself in a crisis.
Okay.
A scandal involving a subsidiary had sent their stock price plummeting.
Sounds like a classic Graham opportunity. A good company temporarily out of favor.
That's precisely what Buffett saw. He did his due diligence, meticulously examining their financials and their business model.
So he was channeling his inner Graham and Fisher, combining that analytical rigor with a deep understanding of the business.
Absolutely. And what he discovered was a company with a durable competitive advantage.
Okay.
Their brand and their network of merchants and cardholders.
So despite the scandal, the core business remains strong.
Yes.
They had a moat around their castle, so to speak.
Yeah, that's what Buffett believed.
Okay.
He recognized the scandal as a temporary setback and saw the intrinsic value of American Express, far exceeding its depressed stock price.
He found that margin of safety Graham always emphasized,
Right.
the cushion protecting him from potential downside.
He did. He purchased a significant stake in the company, and as we know, that investment became a massive success.
American Express rebounded and Buffett reaped the rewards. A textbook example of his early investment strategy.
It perfectly illustrates how he combined Graham's margin of safety with Fisher's emphasis on understanding the underlying business.
Okay, so we've got American Express, a classic value play.
Right.
Now I'm curious to see how his approach evolved as he gained more experience.
Let's fast forward to the late 1980s and examine his investment in Coca-Cola.
Oh.
This one highlights a key shift in his thinking.
Ah, Coca-Cola, a legendary brand. What made this investment different?
By this time, Buffett was incorporating more of Fisher's and Munger's influence, moving beyond purely quantitative analysis.
So he was less concerned about finding statistical bargains and more interested in the long-term potential of exceptional businesses.
Precisely. He recognized Coca-Cola's incredible brand power, global reach, and a product that was essentially recession-proof.
It's like they say a moat as wide as the Mississippi.
Exactly. And unlike American Express, Coca-Cola wasn't facing a crisis or trading at a discount.
Okay.
Buffett was willing to pay a fair price, even a premium,
Okay.
to own a piece of this extraordinary business.
He was putting Munger's advice into practice, recognizing that quality sometimes commands a higher price.
Absolutely. And once again, his conviction proved correct.
Okay.
Coca-Cola's stock price has continued to climb, generating substantial returns for Berkshire Hathaway.
These examples show a clear progression in his approach. He wasn't afraid to adapt and evolve, moving beyond simply hunting for undervalued assets.
That's a crucial takeaway.
Right.
He realized that a truly great business, even at a fair price,
Okay.
could outperform a mediocre business bought at a bargain.
Right. It's like the difference between buying a used car that might break down
Ah,
and investing in a reliable vehicle that will last for years.
a perfect analogy.
Yeah.
Buffett shifted from a purely quantitative approach to a more holistic view,
Right.
considering both the numbers and the qualitative aspects of a business.
This is fascinating. It seems like he was constantly learning and refining his strategy.
Yeah.
But did he ever make mistakes?
Yes.
Were there any investments that didn't pan out as expected?
Even the Oracle of Omaha isn't infallible. One notable example is his investment in Dexter Shoe.
Dexter Shoe. I'm not familiar with that one.
It happened in the early 1990s.
Okay.
Dexter Shoe was a well-established American shoe manufacturer, known for its quality craftsmanship.
Sounds like a solid business. What went wrong?
What Buffett didn't fully anticipate was the rise of cheap imported shoes, primarily from China.
So globalization and increased competition caught him off guard.
Yes, the influx of lower-priced shoes significantly impacted Dexter's pricing power and market share.
Even a great company can be vulnerable to unforeseen market forces.
Exactly.
It's a reminder that no investment is without risk.
Exactly. The Dexter Shoe investment highlights that even with thorough analysis, some factors are impossible to predict with complete certainty.
So even Buffett isn't immune to market surprises.
Yup.
It makes him seem more human relatable.
It does. The key is to learn from these experiences and adapt.
Right.
Buffett has always been incredibly transparent about his mistakes, viewing them as valuable learning opportunities.
Okay, so we've seen how Buffett's strategy evolved over time, from bargain hunting to recognizing the power of exceptional businesses.
Yeah.
We've also seen that even he isn't immune to mistakes.
Right.
And that brings us to the most important question. What can we learn from all of this?
Right.
How can the average investor apply these principles to their own portfolio?
That's what I'm eager to unpack.
Hmm.
What are the key takeaways from Warren Buffett's investment journey that we can implement in our own lives? Let's distill some of those golden nuggets of wisdom, inspired by Buffett himself.
I'm ready to take notes.
All right, first, remember that price is what you pay. Value is what you get. Don't just chase cheap stocks.
Right.
Focus on understanding the intrinsic value of a business, just like Buffett did with Coca-Cola, projecting their future cash flows and brand power.
So it's about looking beyond the current price tag and understanding the underlying drivers of a company's success.
Absolutely.
Yeah.
Second, be patient and think long-term.
Okay.
Don't get caught up in short-term market fluctuations. Focus on finding businesses that are built to last, like American Express with its enduring network.
It's a marathon, not a sprint.
Right. Precisely. Third, don't be afraid to be different.
Okay.
If you've done your research and believe in a company, Don't let the crowd sway you.
Okay.
Remember how Buffett went against conventional wisdom with his investment in Geico after speaking to their employees?
Think for yourself, do your own homework.
Exactly. And finally, never stop learning.
Okay.
The market is constantly evolving. So should your approach to investing.
Right.
Be open to new information and adapt your strategy as needed.
Okay.
Just like Buffett did when he shifted from pure value investing to a more nuanced approach.
So it's about being adaptable, constantly learning and refining your strategy over time.
That's the key. Those are just a few of the many lessons we can glean from the Warren Buffett way.
This has been incredibly insightful. We've gone from understanding the theoretical underpinnings of his approach to seeing how he applied those principles in the real world,
Right.
both his triumphs and his missteps.
And we've seen how his journey exemplifies the power of continuous learning, adaptation,
Yeah.
and the importance of finding truly exceptional businesses.
Now, I'm curious to see how we can take all of this wisdom and make it actionable.
Okay.
How can we bridge the gap between theory and practice?
That's where we're headed next. In the final part of our deep dive, we'll explore how to apply these principles to your own investment journey,
Okay.
offering tangible takeaways to improve your investing game.
All right, listeners, stay tuned for the final part where we'll make this knowledge actionable and empower you to invest with more confidence and clarity.
We'll see you there.
Welcome back for the final part of our Warren Buffett deep dive.
We've covered a lot of ground,
Yeah.
from those philosophies that shaped his thinking to real-world examples of his successes
Right.
and even a few missteps.
Right. And now it's time to answer the big question. How can we, the everyday investors, apply these principles to our own portfolios?
Right.
Can we really channel the Oracle of Omaha without managing billions of dollars?
Absolutely.
Okay.
Buffett himself believes his approach is universally applicable.
Okay.
In fact, he's argued that individual investors actually have some advantages over giant institutions.
Really? That's surprising what makes individual investors so special in his eyes.
Well, for one, we're free from the pressure to chase, short-term performance.
You're right.
We can be patient, play the long game, just like Buffett did with Coca-Cola Holding for years, even decades.
Right.
Let's compounding work its magic.
So no panicking when the market dips, more freedom to stick to our convictions.
Exactly. And remember, Buffett's strategy is all about identifying those truly exceptional businesses,
Okay.
those with a durable competitive advantage.
Right.
Those with a durable competitive advantage.
Right.
That matters whether you're managing millions or just starting out.
Okay, that makes sense. But how do we actually find those Buffett-worthy companies? Where do we even begin our search?
This is where it gets exciting.
Okay.
It all starts with understanding, the businesses you're considering, going beyond just the numbers. Remember, Fisher emphasized those deep dives, getting a feel for the company's culture, its competitive landscape.
Right. The scuttlebutt approach, talking to people, gathering insights that don't show up in financial statements. But how do we, as regular investors, do that kind of research?
You might be surprised how much information is publicly available.
Okay.
Start with annual reports, company websites, industry publications.
Okay.
Even customer reviews can give you a feel for the brand.
So it's like being a detective.
Right.
Piecing together the story of the company.
Uh-huh.
But what specific questions should we be asking?
Yeah.
What are the clues we're looking for?
Start with the basics. What are their products or services?
Okay.
Who are their customers? What makes them unique? Then dig deeper.
Okay.
What are their plans for the future? What are the biggest risks they face?
So it's about understanding the why behind the numbers.
Right.
Seeing the big picture, not just focusing on short-term price fluctuations.
Exactly. And don't forget Graham's margin of safety. Even with a fantastic business, you need to buy it at the right price.
So even a great company can be a bad investment if you overpay.
Yeah.
There's no such thing as a sure thing.
Unfortunately, no.
Right.
It's about finding that balance where the price you pay reflects the potential downside risk. Just like Buffett did with American Express during that scandal. He saw the intrinsic value as much higher than the market price.
It's like snagging a designer item at a deep discount. You've got a great deal, but instead of fashion, we're hunting for long-term value in businesses.
I love that analogy.
Yeah.
And finally, remember that patience is a virtue in investing.
Okay.
Compounding takes time.
Yeah.
So don't get discouraged if your portfolio doesn't explode overnight.
So we need to be in it for the long haul, not chasing quick profits.
Right.
Think decades, not days.
That's the Buffett mindset. And with the right approach, even without billions to invest, you can achieve remarkable results.
This deep dive has been incredible. I feel like I've not only learned about Warren Buffett, but I've also gained like a whole new framework for thinking about investing.
It's been a pleasure sharing these insights. And remember, the most important lesson is to never stop learning. The market is constantly changing, so we need to stay curious, adaptable, and always refining our approach.
Just like Buffett himself. Well, listeners, that concludes our exploration of the Warren Buffett way. We hope you've enjoyed the journey and gained some valuable tools to empower your own investment decisions.
Happy investing, and until next time, keep those minds sharp and those portfolios growing.